Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, January 26, 2023. It's 11:36 a.m. Eastern Time. So I'm starting this video. It'll be part two. As I mentioned, the last one was inadvertently stopped on coverage of the last few Dow components. So I'm going to pick up there. This is the Dow again, just showing the Dow. Had taken out its primary downtrend line, back tested after putting in a divergent high. That was a catalyst for the back test. So as of late, it's so it showed outperformance over the Nasdaq. A lot of money flowing into steady Eddie dividend paying blue chip stocks, going out of high flying tech. But lately, the Dow has been sucking wind, so we still have it above this minor trend line here. If that breaks, I would expect a full back test of the trend line here. But let me finish on those components. So we left off starting to cover 3M, and 3M you can see is clearly in a downtrend. I mean, this is a textbook downtrend. A security making lower highs, as I've circled there, and lower lows. That's what it looks like. And right now, there aren't any divergences. We're not overbought or oversold. Now, anything can happen, obviously, but there's really no case to buy this stock that I can make. If it recovered 180, 118.23, that was a break of support recently, then yeah, you'd probably get a rally, maybe another test of the 200s. But as of now, the trend is your friend. Again, I wouldn't. This isn't not my kind of stock. I don't care to. I don't have a position in this one. I'm just showing you that there's that's what a downtrend looks like. So unless we have some strong evidence of reversal, meaning the S&P 500 and NASDAQ 100 both clearly take out their 200-day moving averages and their primary bull market trend lines. It's was that Newton's second law of physics? A body in motion stays in motion unless acted upon by an equal or greater force. And so, in other words, in a trend and a bull market, that's the trend. You can pull backs, but until the sellers outweigh the buyers, that trend's going to continue. And this is a bear market for 3M at least, and until it's acted upon by a greater force, such as more buyers and sellers, that's going to continue. But again, I've not spent much time on that. I'm just pointing out that's what the chart looks like. That's what the stock's doing. Travelers, this one they haven't yet got. I'm referring to the market snipers that go out hunting during a bear market and look for those stocks that haven't yet gotten the memo. This one just recently hit an all-time high right here, and right at a time where, or just before, everyone decided, hey, let's buy those beat down tech stocks. Let's get some Amazon that's down 55, 60, 56% off its highs, and Meta, the 80, whatever it was. And so either way, for whatever the reasons, I think it's hard to argue that. That's a fact. I'm not stating opinion. I can't tell you factually if this got sold from funds dumping, but it is a fact that there is sector rotation always happening within the stock market, different times, and that's what the pros will do, is they'll start harvesting profits on the big winners, especially those that are getting up there valuation wise. And again, you can't make a call to short or sell a stock just because it's going up, just because it hasn't gone down. What you can do is look for a bearish chart pattern, and this was a textbook bearish rising wedge with a textbook impulsive breakdown. That's what you want to see. I always say, stocks that kind of limp through there, close right on the line, can certainly follow through, but as I like to say, you make up a lot of terms in trading. I like to say on a sell signal, the redder the better, and that's a big red candle. Validated it, and then it happened fast. So if you missed it, well, guess what? You had a second opportunity in the last 2 days on the back test. So you either take a breakdown of a bearish rising wedge, and if you missed that, or if you took a partial position you want to add, you add on a back test. And so all the better when you see rejection. So you back tested it 2 days ago, and then yesterday the red candle, the rejection, and today follow through. So it's still an objective short entry. You're right at the breakdown point where it broke down if you look across horizontally, and that's still, well, that was the first target and that's already been hit, so chances are we could get another reaction. Certainly we could trade here for a while, but once 180 115 is broken, that should open the door to the next target down there to 174.63. And look how those two, well, the 200s, I always say this, 200-day moving averages work great on tech stocks, tech heavy indexes, and other stocks and other sectors and indexes, but I judge each stock on their own technicals. In other words, a 200-day, you can see Travelers kind of slice through it. It's done not a bad job, and you'd want to look at the weekly chart. But I can see it kind of trading through it a lot. So this needs a better set of moving averages. But with that being said, in a bear market, people tend to hyper focus on levels like that. So I just wanted to point out those 200 days both come in with that 174.63 target right there. And then ultimately, if you're a longer term trader, I think this is where Travelers is going at minimum down to 149.65. So there's your target for that one. Dow, not much of an opinion. There's a potential uptrend line there. This one's kind of in no man's land. Again, I don't have a big opinion. A little triangle pattern forming there. WBA, Walgreens Boots Alliance, downtrend line breakout, put in a divergent high that sent the stock back down to back down for a back test of the trend line, and that's where it's at now. I don't have much of an opinion on this one. If I want to look at a glass half full, we can see a potential, or I see a potential inverse head and shoulders bottoming pattern. This would be your left shoulder. That's your head. And there's your right shoulder, getting a little long in the tooth for symmetry, but they don't have to be perfectly symmetrical, meaning this shoulder can be a little smaller or larger. But the thing is, at this point, since it's getting long in the tooth, you wouldn't want to see it go down much more. You have, the symmetry, in my opinion, is not, it's too out of whack to consider that pattern. So what you want to see now is WBA to start to rise. Obviously, you're going to want to see the S&P break out above its downtrend line 200-day for this thing to play out, because inverse head and shoulders a bottoming pattern, and then the breakout is the measured target is the distance from this neckline down to the head. You add that there, and that would bring the stock all the way back up here somewhere. And that's not going to happen with the S&P 500 going down another 10-20%. So those are the things you want to see. The S&P starting to firm up, ideally, and you want to see this stock start to move up from here, and you also want to see it on increasing volume. A lot of folks forget to scrub their head and shoulders topping patterns as well as their inverse head and shoulders bottoming patterns for volume. You want to see a rise in volume on two levels: on the formation off the of the initial leg down off the head there, or up on the right shoulder, right on the right shoulder there, and right here on the head. You had a volume surge on the head, and then you want to see it again on the move up on the right shoulder, and that's what to look for. Otherwise, it's just a potential pattern, and even if we get that, then you have a fully formed pattern if you get the right shoulder finalized, but then you still need the breakout, and that would come above the neckline. So let me just do something here before I forget. I just put here note. I know what that means. It helps me recognize the pattern later. If I had time, I'd just write in LS, head, RS. All right, moving on. That was the last of the Dow components. Here, let me cover some more for you. Let's go into some of the recently highlighted trade ideas. Oh, you know what? Let me do something. I wanted to start the video out on the small caps because I just covered and reversed that. I gave you that as a trade idea today. My RTY hit this right before the video started shortly. The 1888 target, that line right there. So pretty decent support, likely to produce a reaction. We've already gotten a little bit of one, but then I think we'll break that and go on down to the next target or targets there, which will be that trend line again. So something along these lines there. what's next? Let me see. I have a bunch of individual stocks just to update. CRM, these are all individual trade ideas I threw out. That one broke out the other day as mentioned. Just hit the downtrend line, or the 200-day simple moving average, and it's still a little shy of T1. Again, I can't remember if I covered that in the other video. I think I did. Didn't I cover? Yeah, I covered Disney, CRM. There's Disney. Yes, I now recall I covered these in the other video. Oh, maybe not. Maybe not MKTX. And forgive me if I do. I write these notes down. I go through these videos. I get back to my own trading. Have to produce and type up. I do everything to get the videos out. MKTX I mentioned back here is one of my favorites before the breakout, and then after the breakout, this one went up, hit first target right there. My first target was 290.87, call that 291. That was it right there, and then went in and recently hit the next target there, 335.90, and you can see, as is the case, you usually get a reaction on the initial tag each target. This reaction came in the form of a consolidation, which is more bullish than a pullback, and then boom, yesterday a big green candle breakout there. Would I chase it here? Absolutely not. In fact, I took profits at 335.90. It's in hindsight, I wish I didn't, or if I was watching yesterday. Let me see if the breakout was, yeah, see the breakout didn't gap up or anything. It broke out and then just kept going. So if I had a price alert set, I would have. And sometimes I forget to do those things. Either way, this point, it's getting a little stretched. And all I would tell you, it's in no man's land. That's what I refer to a security that's smack between support and resistance. I would best wait for a pullback. Well, actually, I wouldn't do anything. I wouldn't buy a pullback yet because the indexes are at major resistance. But if we do get a pullback and it looks like the indexes might be able to take out resistance, any pullback to that trend line would be an ideal add-on or re-entry to that one. Tesla, I don't think I covered Tesla earlier, and this was one of my the three favorite market leaders that I recently went long on. Out of this one, I took profits there, as I told you, but it's headed up. I gave you this would be my max target. I told you at the time we're getting darn close. So if you did take this one and you held with it or bought back in on the pullback to the uptrend line, we're getting very close to my what I listed way back here. I think even before the wedge broke out as my max target, and that'd be 54%. And I think I stated that back at the time, and I'm sure there were a lot of eyes rolling when I, mentioned the Tesla, which was of course in free fall at the time, might go on to, post over a 50% return in just a few weeks. But that's where we're at, guys. But close enough. Look, like here's the thing. At this point, the indexes, remember, are testing major resistance. Now they can break that resistance, and Tesla could certainly go more, when you look at the daily chart. But this is a pretty good time to start taking some profits. Tesla has, I'm going to put a support zone. See this reaction high right there, and that reaction low. This is the level, and that's probably comparable to that level I just gave you on the 60-minute chart. So about 167, and the way I look at it is that is the next and likely resistance. But from where we're at right now, you're talking 3%. With the indexes, that resistance isn't worth it. So I would, if I still had the stock, I'd do one of two things right now. I'd either just take profits. I'm not going to get greedy and try to get that extra 3%, or I would set a relatively tight stop. Relative is to the, depends on the price of the security and how volatile. This is a stock that goes up and down, sometimes double digits in a single day. So you might have to give it a little bit of room, maybe below today's lows, or like I said, my preference would be just pull the trigger, take the profits, and wait for the next setup. And that might be a pullback to this uptrend line, it might be a pullback to the downtrend line, or backfill the gap right here, today's big gap. Those are objective entries. Again, if you think that there's more to come in Tesla. Otherwise, if you look at the big picture, this is my big picture. I talked about this. I told you yesterday before earnings, if Tesla popped, it would be an objective short on the back test of this trend line and or that 183.50-ish level. and we're at the trend line, so close enough for the next leg down. Next target 94.63ish, then 64.50, and then ultimately this primary bull market uptrend line. And that's that. And I recently highlighted lumber. A week or two ago, I showed you this bullish falling wedge. You had a clean, very clean downtrend line with positive, aka bullish divergences. That was the first time. In fact, it was two things were the first time in a while. We had a pullback to the primary bull market uptrend line. That goes off the 2009 lows. Hopefully, you can see this lighter color I'm using here. If not, there's a trend line there. And so doesn't get much better than this. That was a divergent low, aka positive divergence at support. And if you took that one, let's just say that, and you play the game, the high to low game, this lumber price has rallied 526%. May or may not do that again, but all I can tell you with certainty is this is an objective entry, well, at the trend line, and then the breakout recently, as I highlighted, and then I showed that to you on the 60-minute chart as well, the breakout there. Let me cue that up. This is an end-of-day chart. It's not reflecting today's move. We're up lock limit again. Last couple of days, I've seen us, I think, 3 times in the last week since the breakout. On the 60-minute chart, I've seen the futures hit lock limit. That means all the futures contracts, they all have different limits that they go up or down a certain amount in a day. It locks it, so we're locked up, or we gapped up to lock limit, it looks like, because you can see there's just one candle up here and it's not moving. And if you are, kind of new to futures trading, and you go and put an order to buy and you're wondering why your order's not filling, don't bother calling your broker. Just take a look. That means it's probably lock limit up. That means they will not fill a buy order, only a sell order when you're lock limit up like that. So this is that breakout I talked about the other day. That would be the next buy signal, and we took it out, and there's it. So futures, our lumber futures are up about, put that line there right at about 11% in just the last few days. See, gapping up. The divergences, I warned about these. They're close, but not yet to being taken out. Now, usually when you're seeing this kind of buying pressure, these gaps up and hitting lock limit, usually you're going to burn right through the divergences. That's usually a good sign. These are momentum indicators, but the momentum is far from waning right now. It's building. It's building so fast they're having to hit the brakes on it. The exchanges. So anyways, that's and again, that's small picture. This is 60-minute. This is what helps us hone our entries and exits and time the entries and all that good stuff. I even mentioned it for a little quick pullback trade the last time it hit there on the trend line break, and that's what you got. But going back to the bigger picture is this, and lumber is a lot like, it reminds me of natural gas. By that I mean this thing is either full throttle up or full throttle down. You see these curvy lines? Those are parabolas or parabolic trend lines. And so, like natural gas, this thing can go parabolic, and it often does. And it's, like I said, either usually full throttle up or down with very little in betweens. That's what natural gas has been doing lately. In fact, let's cue up natural gas because that thing is about to explode. It's dumping, smashed right through that support zone. I took a shot there. Nothing ventured, nothing gained. Next decent support I have is all the way down here at about 250. Remember, this is also an end-of-day chart. That's a limitation to stockcharts.com. I keep a subscription there just because I do like some of their charts. I've got a lot of different charting platforms I use. Today it's down another 8.77%, trading at about 280. So we're getting close to that support level there, and we're also getting close to oversold. Last time, and we didn't even hit the 30 level all the way. We were right about where we are now. Actually, we were higher right there and higher there, a little bit above. We're at 31.20. Actually, take that back. That was yesterday. We are now oversold. That won't be reflected until tonight's close, and so let's just show you the oversold or near oversold levels. That one came there. There was a little bit more downside to put in a divergent low, but not much. Could have bought it on the oversold alone. That one right here, a little downside. What I'm getting at, if you bought just these weekly, and this is, I'm sorry, I'm talking fast. This is a weekly chart. I can now see it's truncated there. Now you can see the whole thing. Point being that if you just stepped in and bought, sometimes you were a little bit early, and sometimes not. That was a one and done. Look at that quick pop. Now you had to get out. There was another down. Quite often, oversold drops to that 30 level are followed with another higher low on the RSI to put in positive divergence, but sometimes it is one and done. So again, what that's saying is, yeah, we'll probably get a pop here very shortly, and quite likely another drop, and that'll give us positive divergence. If so, I'll certainly be highlighting that. But sometimes, like I said, sometimes you do get one. Well, that was divergence. That was divergence. You can see more often than not, you get divergence, but you do get those single one and dones there that at least give you, and I'm talking, just to kind of put it in perspective. The price swings in natural gas are huge. Just this little, quote unquote, little pop. I'm going to measure it for you right there. From low to high, that was it pops up on the left of the chart all the way 43% in just a couple of maybe a month or two. So anyways, food for thought. So we're getting there. If you look at UNG, if you don't trade futures, UNG, go to weekly chart, and that's it. This is pretty much as low as natural gas has gone in recent years. We're right there, right around support. Oversold. The last time we are fully at the we're at 28.81 on the RSI. The last time we crossed below 30 was right here. If you stepped in and bought that drop, I'm gonna measure it for you. No guarantees it'll do it again, but that was right here on that red candle, and that was followed by a rally of 64%. All right. So we're getting there, and the time before that was right here, and then right here we had a tag at the bottom of the 30 level as well. So it's very unusual there, and that was the only other one right there. And that one, see, that one didn't do much. You had a little pop. It was a tradable bounce, but it put in a marginal new low. I guess that's the takeaway. Maybe stay away from the leverage things like BOIL, the ETNs that have leverage in a straight UNG, so you don't have the decay, and maybe a half a position. And then if it drops down another 10, 15%, another half. And I'm talking big percentages because this guy, you got to talk in double digits. Natural gas typically moves up and down, high single digits to double digits in a given day, and it can do it again the next day and the next day, and it can do that, and it has been for weeks. So I just have to say that because I know you got a lot of comments. The last trade didn't pan out. We've had quite a few that have this year, and once in a while they don't. And when they don't, they're ugly. That's the nature of this beast. Like I said, this sucker is usually full throttle up or full throttle down. Okay, so what's happening lately? Stock market's strong because people are not afraid. They're starting to put the toes back in the water pretty aggressively too, might I say, into big tech, and of course, big tech's the market, so the market's rallying. Everyone's like, "Ooh, the Fed did it. They engineered a soft landing." And what have I been talking about? Let's get to that. I've been talking about the vicious cycle or negative feedback loop between inflation expectations, both real and perceived, and the stock market and what the Fed's doing. So commodities, yes, natural gas, I just showed you that's plunging, but remember crude oil has a much bigger impact on inflation than natural gas, and crude oil has been moving up lately. Here's a downtrend line, a potential downtrend line. It looks like it could break out. Remember, it put in this divergent low right here. That was positive divergences. So if crude breaks out sooner and does this, if it breaks out and rallies up to my next target here at 78.41, sooner than later, that's the big question, how soon the market will get the memo, and it's a function of how fast and how far it moves up. Maybe a breakout in itself, maybe a 10% rally in crude, maybe it goes all the way here and the market rallies along with it, and expectation for increased demand for crude oil. But again, there's a push, there's a limit there. It's not a hard line, but just watch this. The more crude goes up, the more it builds a case that the Fed will have to maintain an aggressive or hawkish monetary stance. So that's crude oil, natural gas, gasoline. This affects all of us as well. Gas, look at that's a big level right there. See, about 65.50. Major top there, broke out, back tested successfully, had this that proved to be a false breakout, fell back below, resistance checked, resistance checked, resistance. If it can break that, that's going to be powerful. Otherwise, like I like to say, resistance is resistance until unless taken out. And then you can also just box this. This has been the range. Other than this little period of the breakout, this has been a range for gasoline prices for the last year plus. And so we're at the top of the range now. You know, the MO is to sell the top of the range and hold a short to the bottom and then cover and go long. But again, respect a breakout. That's what I'm trying to say. You want to see the brakes get put on a stock market rally, you watch and see what happens if crude oil and gasoline break out and really start to run, that is, you know, not anything more than just a false breakout. All right, ones to watch, also trade ideas if you like them. Take them that way. And let me get back to the other commodities. I'm just going through. I have a commodities watch list. I'm going through these in no particular order. Wheat, I know we took a shot here and here. Here even, and that one played out. This is really setting up nice, and that's not going to help the inflation trade. You know, wheat's obviously a big, big input cost to food prices, and even just everything across the board. So that's a clean downtrend line. Large positive divergence has been building. And remember, just take a look at the big picture. We're in a what I believe to be early stage bull market action. We are coming off a decade-long plus year bear market in commodities that appeared by just about every metric to end right about the time COVID hit. And since then, we've been taking out higher highs. Now, this one's corrected a little bit more so than most. And that's also because of what happened in Ukraine. You had this parabolic blow-off top. Too many lopsided trades there on the long side. But again, we are still well above, the recent lows. And we could even go down quite a bit as long as I think we remain above $6. I don't see us going that low, but that to me, this was the basing pattern at the bottom. There was our breakout and back test. So anyway, it looks good on the daily chart, and it'll look a lot better if it can break this trend line in that 777 level. Wheat futures. ZW, this is my 6-month 2-hour candlestick chart. I'm not super crazy about the trend line because I had to have one little violation there, but it's still the best I can do, and it's decent. If you do that, you do have the 1, 2, 3, and now 4 reactions. So if we can pop up a little more, like I said, just take out that downtrend line on the WEAT that I just showed you, the ETN, then the futures should rip. And of course, that's going to sooner than later. We've been, I try to stay 3 steps ahead, or a couple steps, as many steps ahead of the market as I can. Sometimes, overall we've done a pretty good job of that. And so all eyes in the media. I'm sure if I turn on TV today, I haven't had it on a couple days, they'll be talking about how tech's doing, and tech's and the bear market's over and all that stuff. And so they're not talking about commodities because that's not anything to be talked about lately. They've just kind of been, they had their correction, but they've been, building momentum. These are the what we're looking at here. That's the momentum indicators, the RSI, the PPO, building positive divergences. And so you'll hear them talk about this when after wheat breaks out and runs up. That'll give you a first target right there for futures traders. It's right about 800. And that would be about a 5, nothing huge, but about a 5.5% lift, and that in addition to what we've already done. And again, take it all collectively. Put a bigger weighting on crude oil than you would on wheat, but then look at everything together, and that's what I'm going to do. I'll try to speed things up a little bit. I told you guys in the last video I'd be covering a lot of different things here. So wheat's set up to run. Sugar, I mentioned this one back here is bullish. The breakout above that wedge triangle pattern right there. It's been moving higher, pushing up against all-time highs, and this is a kind of a trading range. Now, I highlighted comparable trading ranges in a lot of indexes in the stock market at the end of 2021 and early 2022, and I was bearish and expecting a downside break. Now, why would I be bullish and expect an upside break? Just because I'm trying to support my case for commodities? Well, no, I'm not trying to. It's just it's how I see things. Remember, the stock market since 2009 has been in one of the most powerful uptrends in history, whereas commodities were in one of their strongest bear markets since that time. So that's why we had almost an identical or very comparable trading range. I highlighted many of the indexes and many key stocks, and predicted or expected a downside break. But this is not a topping pattern because we're not topping. We're coming just off the bottom of a bear market. We're in early stage bull market action. Okay, so that's the difference there. Not late stage not late stage bull market action. So therefore, this is most likely a consolidation range that will pop to the upside. And if it doesn't, you've got great support not too far below at $8, and that's Kane. SGG is the other sugar ETN. NIB is cocoa. Cocoa, I mentioned this one back here. I think either at that support and or on the breakout of this bullish falling wedge in the back test, and then again on the breakout of this trend line, and said, big picture again. This one is, I mentioned too that cocoa is probably the most lagging of all the agricultural commodities, especially the grains that I follow, but yet it's still, it's still off its lows, and this one has plenty of room to run, especially once this primary downtrend line's taken out. That'd be your next target up there, about $35. That's NIB. It's the ETN for cocoa. Oil, this is just a crude-free oil ETF, and kind of this one's basing in that range. Wood is a ETF that tracks, holds lumber, timber and forestry companies, paper companies, things like that. And I already covered lumber futures. It's the closest proxy because there's not an ETF to the best of my knowledge, nor has there ever been for lumber that directly tracks lumber prices or lumber futures. So you'd have to use this as a kind of a quasi proxy. DBA. I've talked about this one in the past many times. This is a one size fits all. There's your commodity bear market. This is a well diversified agricultural commodity. So if you want a pure play on all the ag commodities, this is your best bet in my opinion. There's the last bull market high back in 07, early 08, and the bear market ended there. That is a textbook, very clear. Doesn't take an expert technician to say that was a bear market, a downtrend line. Nor does it take an expert technician to say, look, we've now taken out multiple previous reaction lows, so this appears to be not a correction. This was a bear market correction. Fell well below the previous high, as did that rally, as did that one. This appears to be early stage bull market action. And this is why, among other things, including but not limited to long-term, the secular trend in interest rates, I believe this is only the start of a new era of inflation and higher rates and higher commodity prices. And like I said, we'll see the abatements along the way. Market will rally and cheer it. That's your next target in DBA, all the way up here about almost $23 right there if you want to swing trade it. And it's at very good support, so it offers an objective entry here. That support's down to about, call it 19. I'm going to round down a little bit, and yeah, you're below the 200-day moving averages, but again, good price support, and you take a shot and maybe have a stop somewhat below 19. Seems objective for a swing up to that next target of whatever it was I just told you, 23, I believe. Yep, that's right about that previous high. There it is. And there's the, you can see what it holds here. Cattle, 14. I haven't updated this in a few years, but it's going to be roughly that. Cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, feeder cattle, cotton, you name it. It's got it all. USO, I already covered oil, but there it is. Kind of have this on USO, this wedge, big, large triangle pattern, symmetrical triangle pattern. Bullish for crude, not so bullish for the stock market. Bearish for crude, more bullish for the stock market, unless, like I said, big asterisks in there, unless we get this because of a big wave down and a new leg down that takes us well below the lows in the stock market. If crude's doing this, that's not necessarily bullish because that's due to demand destruction. Corn, there you go, corn, another symmetrical triangle pattern, pop above, bullish. And because the fact that by every metric this thing is in a bull trend, that would be the favored scenario, but you got to respect a downside scenario. Don't fall in love. If it does, falls down here, I'd be a buyer at about $23 at that support. GSG, this is another well-diversified commodity ETF. Just kind of shows you the bigger picture or the inflation trade. There it is. There's your triangle pattern. So commodities right now, like the stock market, I've been saying for the last couple of weeks, the stock market is at a critical, very, very important technical juncture. The downtrend lines, the 200-day moving averages. There couldn't be a better level. Even the recent lows, the test of the recent lows wouldn't be as important because sometimes you undercut those and then you put in a divergent low. So you have everything is kind of make it or break it right now, and because you're in a triangle and you're pinching towards the apex, this thing's got to break one way or the other sooner or later. The closer you get to the apex, the less room you have. So, if you can be patient, I think we should know maybe after next week when all those big remaining FANGs report which way things are going to go. Maybe it's going to take a couple weeks, but it looks like a big move's coming soon. There's soybeans. Look at that uptrend line right there. You can buy pullbacks to the uptrend line. You can use a solid break below as a stop, or give it a little room. It's in a bull market. I'm going to pull this down. That's support right there at about $26 if that breaks down. So what happens in a bull market? A lot of times you get these trend line breaks. They look like legit sell signals, and but then the buyers step in at the shallower early support levels. Whereas if I was looking at a major top in soybeans, I'd be targeting a much deeper pullback. But as of now, the trend is up, and we're not far off multi-year highs. But again, bigger picture says, well, actually, soybeans have gotten back to where they were back in 2012. This ETF already only goes back to 2012, so it doesn't encompass the entire previous bear market. TJP, one of my go-to proxies, it's well-diversified commodity ETF. There's your downtrend line, pop above that, and this little box here, the spacing pattern is going to be bullish. The positive divergence in place says that's the most likely scenario, and if we get that, next target's 37, and if they take that out, this is where the stock market's going to really start to worry about a breakout above 37 in TJP. Otherwise, if they take it down, I've got support about 31. I'm not overly concerned. If we do that, we'll still have the divergence. Anything much below 31, then maybe we're going to see further abatement in inflationary forces. Cut, the other lumber and forestry ETF, there's a triangle pattern, bullish above that, bearish below that, right? Cow, it's livestock, kind of, just looking a little EKG-ish lately. I don't have much of an opinion on that. Coal is no longer trading. MOO, this is agribusiness ETF. So this is like your, John Deere and Caterpillar and those kind of things, big machinery and combines and things like that used on farms. There's a breakout, a back test, and they are stocks, so they're only going to go up so much. If the market goes up, and especially the Dow and the S&P, you're going to see a much higher weighting of these companies like John Deere and all that in the S&P than you will see in the NASDAQ. But all right, I think I've covered them all. There's a grain ETF if you don't want to buy either corn, soybean, or wheat separately. This gets all three for you right there. It gives you a little more diversification. One stop for all three. Break above the triangle would be bullish. Break below is going to be bearish, but plenty of support below. So not lights out bearish, just maybe a, another pullback to that 69-ish support. Cotton, BAL, gave you, I guess I would have laid this one out back here. We had positive divergence, breakout. We hit my first target here. Been consolidating since. Once we break T1, which was 63.85, we head up to T2 and or this downtrend line, whichever comes in first. They'll probably come together and then work our way up here like this. JJU, aluminum index, JJC, copper. See, copper's rallying. All those things. I remember gold, silver. I said they were the ones that didn't get the memo. I said, from a fundamental perspective, we had palladium, platinum, we had every commodity soaring, and gold. My as I told you back then, my expectation was I think that whole Bitcoin, all the Bitcoin fanatics, and even the media kind of bought in that Bitcoin's now the new gold. It's the now the safe haven or alternative to the stock market. And I thought that was the most asinine thing to think about. Gold's been a store of value and a safe haven and inflation hedge for what centuries now. And all of a sudden this Bitcoin comes around for a few years and it's made gold obsolete. And then what I went on to say is people tend to forget gold and silver have tremendous industrial applications. They're used in electronics and everything else. It's not just a hedge for inflation or jewelry, ring to put on your girlfriend's finger. So for that reason alone, gold. And the fact that copper's rallying, this is China coming back online most likely. All right, the video is getting pretty long. We're almost done. There's gold. Gold again needs, as long as the dollar is falling and the euro is going up, gold's going to rally, but it has a very steep uptrend line. And I'll do that in a separate video. We still have divergences forming. There is a correction coming in the euro and a rally in the dollar. I remain longer term bullish on the euro, gold, silver, as I have all along, especially since we had this very powerful, what I considered a huge bear trap, that false breakdown, and then followed by the recovery of 158. So I still think gold's going to new highs and beyond, but it's getting very stretched. And as soon as we get the sell signals in the euro, we'll have a nice correction and get a buy gold at a cheaper level and then get back in. Palladium divergences building right here. Remember the platinum metals, which are palladium, rhodium, and platinum. A lot of those are coming out of Russia. Russia is the second largest producer, I believe, of palladium. So you got a lot of uncertainty there, and you can trade it, but that's a trade I've been staying more away from than engaging lately because of that. Putin's so unpredictable. It's almost a crapshoot. All right, guys, that's it. I rifled through my watch list of commodities. I already covered natural gas. Covered the markets. That's where we left it. A little bounce off this level on RTY and divergence. I think it is time for me to reverse that long. Told you cover right there, right about there. That's where I think this bounce ends, and that's right about where we are. So I am going to reverse and wrap the video up. This has been Randy Finney with Right Side of the Chart. Have a great day.